The chaos you see on a trading floor is a constant negotiation between institutional buyers and sellers. Every single tick on a price chart represents an executed trade, meaning one side thought the price was high enough to sell and the other thought it was low enough to buy. This animation shows a trend bar. We define institutional conviction by looking at the distance between where this bar opens and where it closes. When a bar opens near its low and closes near its high, it leaves a large, solid body. The buyers stayed aggressive for the entire duration of the bar. If the price moves up and down rapidly, only to close right back where it started, the body shrinks down to a sliver. This is a Doji bar. The long wicks show us the market explored higher and lower prices, but neither the buyers nor the sellers could maintain control. Reading this structural difference between a thick trend bar and a thin doji is how you identify who is actually in control.
Professional traders wait for institutional money to reveal its hand and then follow its lead. This chart shows a series of upward trend bars pulling back slightly, then continuing higher. To map the trajectory of this market, we draw a straight line to connect the lowest points of those pullbacks. This creates a structural floor. When the price dips back down to test this floor, we look closely at the bars. We want to see long tails forming at the bottom of the candles, precisely as they touch the line. Those tails are visual proof of buying pressure, institutions placing massive orders to defend their positions. The most aggressive defense you will see is a two-bar reversal. A black bear bar pushes down into the trend line, and the very next bar is a white bull bar that immediately reverses the drop, closing near its high. As long as the price continues to find support at the structural line, the bulls dictate the terms of the market. Eventually, the floor gives way. This animation shows a strong downward trend bar slicing through the upward trend line and closing entirely below it. The market has transitioned into two-sided trading. In two-sided trading, early buyers often get trapped. When the market makes its first attempt to resume the upward climb, the first bar to tick above the previous bar's high triggers premature buy orders. We label this a high 1. Because the bears are still actively defending the break, this early push usually fails. Label this second attempt a high 2. After the first push failed, the bears had a second chance to take control. Their failure to do so on this second dip means that the directional probability of the trend resuming has increased to 60% or better. Professional traders rarely take the first signal after a trend line breaks. Forcing the market to double-check its math by waiting for the second signal is how you avoid providing liquidity to the institutions. This sequence shows a healthy, sustainable trend. The bars are moderate in size. They march upward in a steady staircase, and there is minimal overlap between the bodies of consecutive bars. But after a long climb, an abnormally massive trend bar will occasionally appear. Amateurs see this as strength, but it is actually an exhaustion climax. The last remaining buyers are panicking to get in at any price, and the institutions are using that urgency to exit their longs. To survive this kind of volatility, you must define your risk. This chart shows a completed high 2 entry. We draw a strict horizontal line exactly one tick below the most recent swing low. This is our protective stop. Look at the structure in front of you. Identify the high 2 entry and find the lowest point of the pullback to place your stop. If the price breaks that line, your premise for the trade is wrong. Accepting that mathematical threshold allows you to exit the trade cleanly, rather than holding on in emotional panic. This animation shows a trend channel overshoot. We draw a parallel line above the main trend to map its upper trajectory. When the price accelerates, piercing straight through that boundary, the market is overextended. The next bar crashes back inside, heavily trapping late buyers. Surviving these traps requires strict adherence to the visual rules. Look for trend bars over dojis. Wait for the high 2 setup, place your stop strictly below the swing low, and avoid buying into an exhaustion climax. Every trapped buyer represents real capital. A profitable trade requires someone to panic. Mastering this language reveals institutional footprints, leaving a record of market intent.